So in general, I sell things when they're fairly valued, when I find something better, or if I messed up and I'm wrong. Let's go with that fairly valued thing, because if you're talking about something you're successful in, it's going toward your fair value at some point. Now, value isn't a static thing, because especially in these very out of favor things, when you're starting your valuation, things are so bad that you would never dream. I mean, going back to the Amazon thing you were talking about earlier, you would never dream that they would have 25% growth rates again, or that they would have 10% margins in their core business, or, you know, in the case of the for-profit education, that they would ever achieve, you know, sustainable top line growth and, you know, heaven forbid, like return to the margins, 20% margins they were doing before. So you feel too stupid when you're building your early models to ever bring them back to those things. So when you're first doing it, you're buying them and you're finding that they're undervalued enough, even making fairly unoptimistic assumptions. So the first thing you have to do is reset. Just because the stock goes up doesn't mean it's fairly valued. You need to reset and try to look at it with fresh eyes and say, like, okay, am I still clinging to my former views? Like, I would have sold MasterCard at $250 instead of letting it go to $450 because I bought it at $118, you know? So, and you would have never dreamed back in 2008 that, you know, GDP growth would be 12% again, right? Consumer will never spend again. No one's ever going to use credit cards again. So you have to reset your expectations and make sure you're not being stupid about it. The second thing is you have to I try to put a wrapper around each one about how good of a company is it. So these guys are kind of in the middle, right? They're certainly not MasterCard, but they're also not a retailer, right? I mean, I owned Abercrombie & Fitch, for example, bought it at 25, sold it at 58 to 62, right? And, you know, it's a retailer. It's going to hit a same-store sales problem at some point. So when it's trading at a decent multiple, you should sell it. These guys are sort of in between those two extremes. And so I use that. I use the amount it's away from what I think it's worth, and this overlay of like how good of a business is it? How much do I want to own it longer term? How comfortable am I with the management? All of those things to decide how long I want to let it run toward its fair value or above its fair value, even in some cases, when people get really, really excited about something. So the thing about for-profit education is that it's still so unbelievably undervalued that I have a large position and you kind of have to sit through all this volatility because that's just part of the bottoming process. It's painful and horrible, but it's just part of the bottoming process.